In the 1960s, Edward Altman devised a formula to help figure out the financial health of a company and predict bankruptcy. Today, the NYU finance professor is using his formula on countries instead of companies, with the current focus being in Europe. Professor Altman joins me here on set. Welcome to Bottom Line, sir. Pleasure to meet you.
Happy to be here, Mark.
Sir, the original Z-score that was devised in the late 60s, back in 1968, and those metrics have been used to gauge the financial health and stability of countries, but now you've updated this and the Z-score is now Z-metrics. Talk to us about the difference and why the switch.
Sure. Well, Z-metrics is a just more up-to-date, more powerful version of what the original Z-score model did, which is to assess the probability of default of companies. What we've done now is to make a statement that too often we look at the wrong metrics when we are looking at the health of countries, and we find out too late that they're in trouble, like Greece, like Portugal, like Spain, etc. And my idea is to look at the health of sovereigns from the bottom up, looking at the health of the private sector. So we're now applying these models to the companies in each of these countries and saying how vulnerable are the companies and do they need help or not.
Interesting, because this month you and Maurizio Esentato, he's the CEO of Italy's Classes Capital, you co-authored an op-ed in the New York Times, the Financial Times, and you talked about this. You wrote that most nations can be evaluated by what you call the health and robustness of their private sectors. Is this a paradigm shift in the way we look at how these things are measured going forward? Because it used to be the macro look, right?
Exactly. I hope so. I hope that the final analysis will be a combination of looking at the macro and the micro. Right now, nobody looks at the micro. They take it for granted.
Why do you suppose that is?
Because they're looking at the statistics that the World Bank, the IMF, the ECB, etc., have always looked at, and the rating agencies have always looked at. And I think it should be looked at from the bottom up as well as the top down. And indeed, if you had looked back in 2008, before this crisis started, you would have pinpointed clearly Portugal, Spain, particularly Greece, Ireland, and Italy as the potential countries that would get into trouble.
So what did the Z metric specifically reveal? What were the causes of concern that should have raised a red flag but apparently did not?
It showed that the average probability of default of companies in these countries, these are listed companies on the stock exchange, those are the ones I can get data on, were much higher vulnerability than any other countries in Europe and in the United States, and it should have shown a red flag, and I hope that it will show a red flag, indeed, going forward.
Interestingly, because it seems then that the Z metric is showing that the health of a country's private sector is directly linked to the health of the overall economic picture.
Absolutely. Mark, who pays the taxes? Who hires the workers? It's the companies in these countries. If they're sick, if they're unprofitable, they're not going to be able to do their job.
What did the Z-metric model reveal about Greece specifically?
Greece today has the average company in Greece has about a 16% probability of default over the next several years. That compares to about 11 or 12 for Portugal, Spain. Italy's a lot better, about 8. And the rest of the European countries are down to 3-4%.
But you also wrote in that Financial Times article that the last stand in the debt crisis war is going to be fought in Italy. Why do you say that?
Well, everybody thinks the next step is Spain, after these other countries have been bailed out, and Greece is probably going to be bailed out soon. I don't think that's the case. I think Spain will be bailed out in one form or another, and the European Central Bank will have enough capital, along with the IMF, to do that. But Italy is a different story.
Why so?
Italy is about 3.5 times larger than Spain in terms of its outstanding government debt.
Okay.
Italy is a major European power. Italy has had slow growth, political problems, aging population, many infirmities, but they have a lot of strengths. And I believe the last battle to save or not the euro will be fought on the shores of Italy, and not in these other countries, which we all know about.
We were talking about the situation in Italy. Are there any other countries that you see at risk?
No, actually, it's the 5 countries that we all know, the so-called pigs with the double I. Those are the ones that are clearly at risk. But this contagion effect can even hit countries that you wouldn't think were at risk. And then we'd have to look much more closely. And that's what I think is going to happen in the case of Italy. Although the probability of default as measured by the CDS market has spiked from under 9% 6 weeks ago to over 15% for Italy in just this. Now, I don't know what caused it besides what I think is people beginning to focus on the next shoe that could drop.
And it's interesting because the credit default swap market does indeed tell the other side of the story if you look closely enough.
Yeah, the market. And my metric is a third metric. We've got the macro figures that we all look and debate, and we say, oh God, why didn't we know that about that earlier?
Sure.
We have now the CDS market, which is very timely but very volatile. And then we have a more stable indicator that shows the fundamental health of the companies in each of these countries. And I wish that the central banks in these countries would catch on and monitor the health much more carefully, and when they see problems on the horizon, do something about it, and don't wait until the markets say you've got a problem.
Professor Altman, we have about a minute left. We were talking going to break. If you live maybe in middle America and you hear what's going on in the Eurozone, you say, well, I'm here, they're there, why should I care? Why does that matter to me? Yeah. Could you please explain to people why this matters to them?
What happens in the debt markets, whether it be here, Des Moines, or in Athens, Greece, will impact the stock markets in each of these countries. And that is a big factor for middle America. If the stock market is down, people lose confidence. They begin to worry about their wealth situation, their savings. So what happens in Europe impacts the U.S. stock market, impacts the U.S. bond markets. And therefore, we need to be concerned. Plus, our banks also are at risk in terms of owning the debt of these countries, as well as the European banks. And the banking industry is what is all about with respect to these bailout attempts by the European Central Bank and IMF.
From Athens, Greece to Athens, Georgia. Should be concerned. Professor Altman, thanks so much. Edward Altman, NYU finance professor. Thank you, sir. Hope we can call on you.